I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk to you. It's been pretty wild, I think, in the market since we last spoke. Although the S&P and Dow haven't done much, the volatility's really low. They're barely moving any single day. We've seen big moves outside of those markets with commodities and emerging markets and Turkey and on, that's for sure.
Yeah, so getting to specifics here, the U.S. Fed just released their latest notes. They say there will be an interest rate hike soon. Would that be a surprise to the market?
No, it shouldn't be. When I last looked over the weekend, the Fed Fund futures market had a 90% chance of rate hike in September and then a 64% chance of one in December. That would be 2 hikes, which is what they were talking about in July. But I think the big story is the bond yield curve in 2 markets. There's a global bond yield curve for the world that excludes the United States, and it became inverted on the week of June the 14th. And this is the most accurate forecaster of a recession. And the same week that happened, we saw agriculture commodities tumble, emerging markets took a tumble, and that's when their leg down really started. That culminated with the drop in Turkey, and the U.S. dollar has risen since that date too. But the U.S. yield curve is not inverted yet. It's on track to be inverted probably by the end of the year. It's only a 25 basis points difference between the 2-year and 10-year bond. And if it gets inverted, it'll be saying we're headed to a recession in the United States within 6 to 12 months next year. And to summarize what this all implies, the global economy appears to be slowing down faster than the United States economy. The U.S. still growing, still doing the best. Therefore, there appears to be money coming into the United States, into the dollar, into the bond markets, and so forth, which are helping for now. But I think this also goes to the news item of the day, those Fed Fund minutes saying, yeah, we'll hike again, but we're worried about these markets and this and that, which implies that eventually they'll be worried enough to stop their interest rate hikes, and that will cause some changes finally in the precious metals markets. But it appears that yield curve inversion, which would cause the Fed to stop these rate hikes, probably will be taking place by the end of the year.
When that happens, what message do you think the markets will take, and how will that affect them?
Well, historically, the stock market ends up tipping over for good after that happens. So that would imply at some point next year we'll have a real bear market begin. We could have corrections, of course, between now and the end of the year. It wouldn't shock me at all, especially if one doesn't happen in October, at least to retest the 200-day moving average. My interpretation of the market is we're just in this giant sideways top since January. But that doesn't mean some stocks can't make new highs. In fact, we've actually seen an interesting rotation out of some of the technology stocks, or all of them just about, besides Apple, which made a new high lately, but stuff like Facebook and Netflix are now lagging, when they were the big leaders up until, the start of, July. But money's rotating now into defensive plays, utilities, drug stocks like Pfizer. And this week we saw some news in retailers like Walmart and Target yesterday, but they're reporting increasing sales of I think Target's was 6% increase in sales from a year ago for the quarter, but a lot of this increase in sales is happening because of the bankruptcy of other retailers. So it's not a message of this mega boom, which is the way it's treated when the stocks pop up and people talk about it. But Toys R Us went bankrupt, JCPenney's are closing down, Kmart's are closing down. So a lot of that floor space has vanished, and the shoppers that were going to those places, if you want to buy a toy in person, you got to go to Walmart or Target now, just about. Jeffrey, they took off the shelf and buried him somewhere, and he's gone for good.
We'll have more with Mike Swanson right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, what's happening with the gold market?
Well, that's a good question. I've scratched my head to try to figure that out by watching it very closely right now, because we had a breakdown last week in the gold market. Gold itself had been trading in a range of 1360 as the high and 1220 as support now for almost 2 full years, and the GDX gold stock ETF has been in a 2-year range of 24 as resistance, 21 as support, and that's the tightest range for 2 years it's been in since probably before 1973, and it even narrowed to the point where by April it was trading in a just about 15% range of 23 resistance, 21 as support. The point of this is that 21 level on GDX, and it's similar on HUI and XAU, GDXJ. You can, the listener can pick their favorite thing to track gold stocks, but that 21 level was support actually for 2 years. 18 was the low of December 16, and we closed below 21 this month and jumped down to 18, that low of December 2016. So the question is, and I don't have the answer yet, but I'll tell you what I'm looking for to determine it, which is just as important, is this the low? Is this a false breakdown of this support level, or is this the start of a drop that could continue into the end of the year or perhaps October or something when we have the last Fed rate hike? And that is sort of what happened in 2000, but it's, you can't go back on one historical scenario. And a lot of people right now are they've of course seen the same drop I have, and they're buying, assuming 18 is the bottom, and if they're correct, it'd be the greatest buy of the year. But honestly, I'm just watching it, because, well, first of all, the most bullish case that this is the bottom is the fact that there's only 7,000 short contracts in the futures market held by the commercials, and that's a very low position. You got to go back to that December low of 2016 to find them lower. And to me, that means it can get lower. They can even get positive. So, that's not complete proof for me. In my way of analyzing things, the best indication that you have a final bottom is when you see the gold stocks outperform the metal for at least a couple days. And the best way that happens is if gold were to fall one day 20 points or something and the gold stocks barely drop or even go up. If that were to happen sometime, in the next 2 weeks, let's say, I would be convinced, this is a good chance. This is the bottom here and we can go higher. But so far, the gold stocks haven't really been outperforming gold enough to get me excited about it. And if that trend continues and there's no real outperformance, I think we're probably going to break the 18 and have to go lower before we get the final bottom in here. And the bottom line of all this is we're in a real interesting moment for gold stocks where they can form a potential bottom, but if it fails, we're going to go lower. On one hand, that's kind of a no-brainer for people to try to trade it. You can just buy here and put a stop below 18, and I actually believe there's a lot of people doing that because I know of a couple individuals emailing me, telling me they're doing exactly that. So we'll see what happens, and it's an interesting dynamic that's setting up, and I don't really have a firm opinion that it's the bottom, so I'm not that excited about it yet. I want to see the stocks perform better than gold.
What about other precious metals?
Well, we've sort of seen the same thing happen to silver. It took a hit. Copper actually is taking almost as big of a hit. And all these moves began on that week of June the 14th when the global yield curve became inverted. And it seems to me that what these metals and commodities in general are forecasting is an economic slowdown, and they're reacting a slowdown in the global economy, and they're falling ahead of that becoming the headline news. And the emerging markets ETF has slid. So that's what I think is really going on. And when there's been times in history, at least since the 70s, when there was a currency crisis in other countries outside the United States, there's been a trend of selling those currencies and buying the dollar, which is inside the United States. It appears to be deflationary when it happens, and it can hurt gold prices. That happened, for example, in 1997. It sort of happened in the summer, really, of the fall of 2008. The metals fell with the global economy and the U.S. economy all at the same time, and there's actually deflation. The consumer price index declined for about 6 months. So I fear that could be what these markets are really telling us, that there's a dramatic slowdown coming in the global economy that isn't apparent yet, but is coming. The good news, though, is that if these metals and these other commodities continue to decline, it'll be even a better buy point. So the thing for people that want to invest in the long term might be to just prepare to average in if prices get lower, and think, well, that's really a better case to buy in the long run, because in the end, there will be a time when the U.S. dollar rally comes to an end, when the Fed has its last interest rate hike, and all these, bearish trends that appear to be taking place in commodities will start to reverse. And when the dollar tops out, things are going to be, all this stuff's going to reverse. And we got the biggest short position actually on gold with the speculators. So, when it finally does turn around, it's going to be something else.
We'll have more with Mike Swanson right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, some moves on the crude oil front. Saudi Arabia has announced that it is going to call off its Aramco IPO. And a lot of people were saying that it probably wasn't going to launch anyway because of the lack of disclosure. What's your opinion on this?
Yeah, I think that's the case. They couldn't get a listing on the New York Stock Exchange, and then they tried to talk to people at the London Stock Exchange. These were all negotiations to IPO and list on these places. And the reason was they wouldn't give the disclosure of, full accounting like other companies do. They wanted special treatment. Which in a lot of ways they're used to getting from the United States. That's for sure. And one thing that's happened is the Saudi Arabian stock market had a good rally too this year. It was actually, I think it was the number one performing stock market in the world actually. But it topped out around, that same June 14th date, and now it's been pulling back and the news has come out. They're not going to, be able to IPO their thing, but I also honestly think that, the other week when they did that crazy tweet threatening Canada with terror if they continue to complain about human rights in Saudi Arabia is a symbol to investors around the world that this country really isn't on the up and up. They can't do an IPO with normal, filing and disclosure. Why think that anything else that you would invest in that country is on the up and up either? So that's the ETA. The ETF is KSA. I've never owned it or shorted it or anything, but I think that's one to really avoid. People talk about the lack of disclosure in China and with the companies there, and I'll say, I have bought in the past Chinese companies that made these claims about their earnings and then it turned out not to be true, and I lost money in those situations. I just, looked at the analyst reports and their predictions and, I got invested in a, scam situation, and I think a lot of these Saudi companies that are in that KSA ETF or, some of them would do list on ADRs, I would stay away from them. That's just, I think that's been the lesson to take from all this is stay away from investing in that country.
President Trump says he's going to release the U.S. oil reserve. Will that have a huge impact on oil prices?
Well, it's kind of crazy if he does it. I don't know, why he really would want to. The prices haven't gone up so much that it's impacting people in the United States. They went up a little, but they're coming down. They've been coming down for about 6 weeks now, so it's kind of silly for him to do that. And then at the same time, in a way, if the prices were about where they are now, some of these American fracking companies would be able to come back online and start, producing oil themselves. So I don't really know why. I think he's timing it kind of poorly. And I think the oil prices are probably going to pull back anyway or continue to. Seasonally, they tend to peak out in June and July and pull back into the end of the year. And it looks like they're on track to do just that. So the timing of it makes zero sense unless he thinks it's going to help him, get Republicans, to vote more in the primaries. Kind of that makes no sense.
Plus, I would think the demand for gasoline would be down considering all the wildfires all along the West Coast where people would naturally take their RVs and motorhomes.
Yeah, just get out of there and just find somewhere to stop and, and not drive around anymore. That's probably what a lot of people are doing. But, we got Labor Day coming up and, I know a lot of people do drive on Labor Day on the East Coast but after Labor Day, if it's not till Thanksgiving people do all this traveling. So that's one reason the prices seasonally do tend to dip in the fall too.
So, Mike, how would you sum things up for the past couple of weeks?
Well, I think it's been a wild time, but I'm not the typical American investor who's invested, primarily in the S&P 500 and the Treasury bonds. That's what most people in the United States do, and those markets are barely moving, really. And as long as the S&P 500 is above the 200-day moving average, people in the United States really have no concern about what is going on in the markets, period. But if you look beyond that, a lot of stuff is going on. The yield curve around the world's inverted. Commodities have taken a hit. I think both are signaling a coming global slowdown, and in time that will, impact the United States, the U.S. stock market, even though for now that's not really apparent. But, out of all that sort of wild swings in these markets will come opportunities to pick bottoms. Is this the bottom in gold? We'll see. If not, there'll be another chance. And, if you want to trade it, you just buy it, put a stop on, and it doesn't work, you try again at a lower level. If it does work, it's great. So there's opportunities to do stuff, and markets are moving outside of the S&P 500, and that's what I'm most interested in and keeping my eye on.
Mike, thank you so much for chatting with us.
Great talking with you.
My guest is Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests like Mike can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.